I've worked with developers for the last decade, and in that time we've helped fund hundreds of deals, and today we're going to go over exactly how interest is calculated on most development loans. To start with, there are two different types of interest typically charged. That's retained interest and rolled up interest. They both differ slightly, as one is rolled up on top of the money that you get. The other is retained, which means kept or held back from your initial advance of money, so the money that you actually get in your hand. I thought I'd quickly run over as well, before we get too deep into this, how you work out the actual loan to value and also the interest. It's fairly straightforward, but just in case anybody's wondering. So for the loan to value, all you do is you take the value of the property and then you times that by the loan to value, which is 50%, and then you will get that. So 50% is 0.5 when represented as a decimal. So you times 0.5 times 100,000 to get the 50,000. If you want to work it the other way around, all you've got to do is take the gross loan, so the 50,000, divide that by the property value, which will then get you the 0.5. And in order to change the decimal into a percentage, you times that by 100. Then the same goes with the monthly interest rate. These are always expressed as a percentage. So all you have to do is, on your calculator, is type 1.25 times by the gross loan, which would get you the 625. What we'll do is we'll start off with retained, because on the smaller end, that is typically the more common way that interest is actually calculated. If you can see here on the screen, we've got a property value of 100,000, loan to value of 50%, which means we've got a total gross loan of 50,000. We're going to work for this example at an interest rate of 1.25 per month, which is £625 per month interest charged. A completion fee of 2%, and let's call this 12 months because that's typically the time that you're going to be having a development loan out. Then that means that you have a total net loan of 41,500. So we'll go through how you get to this figure, and this is the retained example. So what this means is that the interest is retained from this 50,000 to get you this net figure. So I'll show you how that's very quickly calculated, because it's a very simple sum. And what you do is you have the monthly interest, which is the 625, times by the 12 months, which gives you 7,500. This figure, once you minus the completion fee as well, which is the 2% of the total gross loan, so 1,000, gets you a total deduction. So this is the amount of interest that will be taken off from the loan that you're getting of 8,500, which then calculates down to 41,500. Example here is typically what you would get on your day one loan. So if you're purchasing the plot for 100,000, the lender for this example will give you 50,000 gross, so the 50%, which net means you get 41,000. So you would have to put in the remainder of the cash into that, the nearly 60,000, to top up in order to go towards the purchase. What happens after that is every drawdown or every tranche as the build goes up, let's say for ease, every tranche is another 50,000. The advantage is you'll end up getting more in your pocket because the amount of time that you're borrowing the money for is actually reduced. So in this example, let's say 1 month later, so 11 months left on your term, you're able to withdraw another 50,000. So you've spent 50,000 on the side. You've done, let's say, the foundations, the footings. Maybe you've got it up, sort of just started doing the brickwork. That would then mean you draw down another 50,000, which would get you to a net figure of 42,125. The reason why this is higher is because you're paying interest for less time. And this is a key point that a lot of people sort of forget, that if you're working out your interest, it's very difficult to work it out precisely unless you know the exact day you actually draw down the money. But this will give you a rough rule of thumb on the assumption that you draw down on the same day every month for, let's say, 6 months, and then the rest are sort of finishing off. So we'll just continue this example here just to show you how that works. So on 10 months, the interest retain drops again. So you're only deducting 6,250. We'll scroll down here now to show you how that works in practice. So here is the total loan that you've got day one. So this is month one. Then if you draw another 50,000, your total borrowing is 100,000. So now we're going to be looking at what the total interest is for both. So above we did what it's like per drawdown that you'd get, but now we're just looking at once we've actually compounded, so added that 50,000 to the other 50,000 to get us 100,000. So the total interest you're paying on that 100,000 per month that you've drawn is actually 1,250. There are some tweaks to this because lenders that typically do each drawdown as their own mini tranche will do it in the way that I showed up here. So it's just if every single drawdown is its own little loan. So you don't need to worry about them compounding because they've already taken it into account. But if you want to get an overall picture of what that would look like, that's where we come into here and you can see what the interest would be. So this figure is two of those, so two 50,000s at the 1.25 a month, but this 50,000 is only been paying for less months. So what you'll see from the 100,000 that you're actually paying double because you're borrowing double. And then as you go down to, let's say, the 300,000 mark, once you've done all 6 drawdowns of the 50,000 each, you'll only be paying the 3,750 for the rest of the time. So that's your interest per month at the 1,250. This is an example of how you can see as you draw down, the interest per month that you're paying increases in line with obviously what you're borrowing until you get a total interest of 35,625. So that is if they did every month 50,000 and then you roll from there. This is what it would look like if you were to actually calculate the interest for each drawdown, add it all together and total it up. On the other hand, there's rolled interest. So this, instead of deducting all this interest from day one, as in from your 50,000, deducting that interest to get you the 42,000, what they do instead is they'll start with the 50,000. So that's your net figure, 50,000, and they will roll the interest on top. This is much more flexible when it comes to the actual net loan you're getting because you know exactly what it will be regardless of when the loan is drawn down. So 50,000 will always be 50,000. Then you would roll the 625 on top of that. Then you'd roll the 50,000 on top of that for however many months there are left. So in this example, you can see how that interest sort of adds up as you go. So each loan is basically the amount borrowed plus the interest. And you can just see it rolling up as you get higher. As you can see, because you're borrowing more money, you end up paying more interest because your net figure is higher. So instead of being the net of 41,500 for the 12 months, you're actually paying interest on a net of 50,000. As you get to larger deals, this is the way it's typically done, but most specialist lenders, sort of small bridging lenders that do development finance, they do work out the interest based on the retained model. It's much simpler to understand as well once you come to actually calculating at the end, because you can see here is the time remaining, here's the interest for that time, they deduct it, and you've already had that taken care of. So you know the total gross loan right from the start. Whereas if you do rolled up, the net loan that you get, you will know what that is, but it will completely and utterly depend on when you actually draw down that money. So most of the time, lenders that do rolled up interest will typically do a lower loan to value day one. The only thing that is missing in this example, which we could add on, is typically there will be also a broker fee depending on where you go. Most brokers add in a 1% broker fee. That's the typical standard, especially on the smaller end of the market. So for this example, we could just add in a 3% on there, which would just pull that up a little higher. Knowing how to actually work out the interest is really important so that you can double check what the lenders do. 99.9% of the time, the lenders work out everything exactly accurately. But for you to be able to anticipate what the cost will be as well, it's really important so that you can actually help balance your cash flow based on the assumption that you know which model you're working on. Actually going through some offers in principle so that you can see how exactly they're laid out, and then obviously you can work out the interest from there. Hopefully you found this useful. If you have or you know someone that will, please share it, and thanks for watching.